Hey guys, what's up? Welcome to another episode with me, Shashank Udupa. And as we all can see right now, the market is going to absolute shit because most of the indices have now come towards the 200-day moving average. Now, I know a lot of you people are sad because since the last 1 year, the indexes have not given any kind of returns, right? In fact, Nifty is sitting at minus 2% from the last 1 year, Nifty 50, mid cap is at minus 5%, and small cap is at minus 9%. So if you are invested in the market, you are seeing an absolute time correction right now, which in all likelihood, a lot of people don't like it. But then the timing of this video could not be more perfect because now in this kind of a market is when you start doubling down on your SIPs or doubling down in your mutual fund portfolio. Now, I know a lot of people messaged me and said, Shashank, okay, you're coming out of small cases soon. It might be expensive for some people. So can you help us understand what mutual funds are good? So today, let me tell you in a quick idea what mutual funds strategy would be great right now. And today I will show you two small cap funds. Next, after that, I will make another video for two mid cap and then flexi cap and so on. So this is going to be like a very fun mutual fund series, and I'll show you deep dive on how I choose my own mutual funds as well and how not to give in to some stupid mistakes that a lot of us do. Okay. Number one, this is the time to double your SIPs. Whenever the market goes down around 5 to 7% from your highs, that is when you start investing into the mutual funds, right? Now, I had recently done a podcast with Ashish Somaya and he mentioned this, that every single year, the market from its high goes down by approximately 10%. And the guy who gets supreme alpha is the person who starts investing in mutual funds or investing in the market during this drawdown period of about more than 10% drawdown every single year. So right now, we're obviously looking at the market going down and I'm very happy because yes, my positions are not doing great right now because it is so flat. But my mutual fund basket can now do better because I'm getting a lower cost of averaging. Now, when I start investing in mutual funds, how do we decide this? Now, biggest mistake for all investors investing in mutual funds, and there is a data and statistic on this, that most investors don't stay invested in their SIPs for longer than 3 years. That means 90% of the people actually stop their SIPs in less than 3 years. And that is where compounding to chodo, you're just paying fees for the mutual fund manager, right? Now, if you are investing in mutual funds, I would strongly suggest go for a longer time frame and stay invested for at least 10 years is when the compounding actually starts happening. So even I have started doing mutual funds, I think 1.5 years ago. And systematically every single month I do the mutual funds. I do not do SIPs on an automated basis. This is hack number one. I do SIPs only when the market goes down because I am looking at the market almost every single day. And even you, whether you like it or not, are looking at the market every single day. So when you know the market is going down and when you know things are going to shit, you keep your money of that month's SIP ready. And whenever the market goes down, buy a little bit of units of your mutual fund. You will get superior alpha by just doing this simple hack. So this is very simple, right? Now, how do we allocate? How do we diversify? I have seen some people having a khichdi of mutual funds also. What do I mean by khichdi? They have 4 or 5 different large caps, 3 or 4 different index funds, 2 or 3 ELSS funds, 4 or 5 mid cap funds, 4 or 5 small cap funds, 2 or 3 flexi cap funds. Basically, you're holding almost 90% of the entire market, right? Why do you need so many mutual funds? What is that fear of not holding the other mutual fund? And that is what I'm going to break your myth today. Now, let us quickly go and run through this episode and understand how to choose a good small cap fund and how do we allocate this as well. Now, before we get into the video, again, I want to thank Grow for making us a part of the Grow network so that we can come out and give amazing content for all of you guys, right? So let's go and quickly check out this entire video. Now, first things first, if we simply go to Money Control and just check all the small cap mutual funds that are there, you will see that right now there are approximately 30 to 50 mutual funds that are currently in the market. Now, I have seen people having a lot of mutual funds. Now, I'll tell you what you would normally do at this point. Most of the people right now in the market, and don't lie to yourself, this is what you do. You will go and do 5-year returns descending to ascending. Basically, you want to see in the last 5 years who's given best returns. Then you will do last 3 years, then you will do last 2 years, and then you will do last 1 year. This is what most of the people do right now. And most of them do 3 years just to see whether what is the new 3-year trend. Now, I'll tell you why I know you guys do this. Because I know in my comment section, a lot of you guys have come and said, Shashank, when you do those mutual fund videos, don't do quant small cap anymore. Why don't you do Bandhan small cap? Why? Because Bandhan small cap is number 1 in the last 3 years. But if you sit and choose like this, right? If I'm sitting and doing descending to ascending order and I'm choosing the best time, every year I will change my entire mutual fund basket. Is that a logical way to go by things? Absolutely not. Because your Bandhan, today it is good, tomorrow it is bad, day after tomorrow it will be at number 4. So every year you will keep switching depending on this. And you know what? if I actually show you data, it makes absolutely no sense. Let me show you why. Let me go and take a 10-year horizon. 10-year horizon, okay, that I'm looking at top funds that have performed in the small cap region for the last 10 years. Because 1 year, there will be a lot of volatility, 2 years volatility, 3 years volatility. But when you go to 5 and 10, you start averaging out the good guys from the bad guys. Because long-term returns is what I'm assuming you're looking for, right? You're not here to invest for 3 years. That's what I said. First mistake, go more than 3 years. Now, if I am looking to invest for, let's say, 10 years or 15 years or 20 years, because that is my goal at the end of the day, then I will just look at the last 10 years who has done a good job, right? Out of that entire list of 50 companies, only 12 companies actually come into this list. 12 or 15 companies come into this list. Now, if I look at the top 5 companies in the last 10 years, you will see that Nippon India is number 1, Axis Small Cap number 2, Quant, SBI, HDFC are in the top 5 right now. Okay. Now, if you look at that again, the difference now, Nippon India's 22.49% return in the last 10 years, and all the other 4 funds are at 20%, right? But if I look at 1 year, 3 year, 5 years, 5 years, it'll all be very complicated. But on a 10-year standpoint, everyone is giving the same returns. The good guys are giving the same return. And who are the good guys? HDFC is there, Axis is there, SBI is there. Now, if I am investing today in a mutual fund, I want 2 things to happen. 1, give me good returns. Don't have to be the best returns. Be in the top 5, I'm happy, because I can never get the best returns, right? Every time things change. Number 2, I want you to survive for 30 years, boss. Tomorrow I can put in Bandhan Small Cap. If Bandhan Small Cap does really well, tomorrow that fund manager can be poached from HDFC and he will go somewhere else. So all these things happen in the industry. So I want to just get long-term compounding. Now, if I look at the top 5, let me take 3 out of this: Nippon, Axis, HDFC. Okay, let me just take these 3 and show you another deep dive information. Now, Nippon India has been the best fund over a long period of time. And if you look at here as well, AUM of Nippon India, 65,000 crores. Second problem that most of you guys do, Shashank, lot of AUM is there. If so much AUM is there, that means my growth will be curtailed. I cannot buy this fund. I will try to find funds with low AUM. First of all, biggest myth buster, even with a high AUM, Nippon has done well. It has diversified longer, more deeper, but it has done well, right? So there is no absolute logic of, higher AUM is bad. Yes, higher AUM does, impact your liquidity, because small cap and mid cap index or even the small cap companies don't have so much liquidity. Okay. But I'm saying if you ignore Nippon, then you still have 3 more guys sitting at 1/3 the market cap or 1/3 the AUM of all of these, which still gives the same return. So technically not a problem. Okay. Now comes to Nippon. Now, Nippon is sitting at an expense ratio of 0.62. Now, for a lot of people who don't know what expense ratio is, every year, if Nippon gives you some kind of returns, 0.64% is what they deduct as a fee from your investments, right? So 0.64 is what Nippon does. Axis does 0.57. HDFC does 0.71. So now if I had to compare the 3, simple comparison, don't overthink it. If I do Nippon and HDFC, Nippon will give me best expense ratio adjusted returns. And if I had to check HDFC and Axis, because both of them have given same returns, HDFC and Axis, both of them have given 20% returns over a long period of time in 10 years. But Axis has given me 0.5% expense ratio, whereas HDFC has given me 0.7, higher, right? So again, now Axis becomes a better fund. So now if I go towards Axis and Nippon only, now let's take only 2 examples. Now both of them are great, but you might have a problem that, Shashank, you know what? I don't want Nippon because the AUM is too high. Okay, then I would say let's go and check the other guy who is there, which is SBI Small Cap. Let us see how SBI Small Cap is doing, because again in 20 years he's also given the same. Now his expense ratio is 0.73. That means Axis becomes my best option, because assuming all returns are same, I'm getting the same adjusted returns with a lower expense ratio. So then that becomes a better option for me compared to, let's say, HDFC Small Cap or SBI Small Cap, right? Axis becomes a better option. So if I want to take a bet, I can take a bet on both. If I want to take only a single bet, then I can take a single bet on one company. But now what I'm trying to explain to you is, whether you invest in Nippon, Axis, HDFC, if you are sitting and optimizing for 0.1, 0.2%, and you keep looking at this last 3 years, last 5 years, last 1 year, last 2 years, you will never make money in mutual funds, right? If you want to make money, you have to take 1 or 2 funds, max 1 to 2 fund in that category. I would love to stick to 1 fund, but if you still want to diversify, take 2 funds and just stick to those 2 funds. That's it. Right? Just invest for a long period of time. Ensure the compounding comes in. Chalo, 1% you will lose here, 0.5% you will lose there over a period of time. You still make money Are you trying to be the best in getting the optimized returns? Because you never get the most optimized returns, right? So we just want returns. We want us. What is the end goal? Ki paisa aa jaye, we can go buy a car, buy a house, relax with our family. That is the main goal. You focus on your active income instead of focusing on last 3 years, last 5 years. Nahi hota aisa. Now coming to, let's calculate the returns between Axis Small Cap and Nippon Axis Small Cap, right? Now, if I were doing an SIP, let's say exactly 10 years ago in 2014, 26th August, 25th August, we'll take the date. And let's say my sell date is 26th August right now. And I am investing, this is returns. Let me do SIP. 10,000 rupees 10 years ago, which is very fair. I think most of you would agree that 10,000 rupees people had 10 years ago. And if you do it for the last 10 years, your annualized returns becomes 21.34. Now again, when we saw outside, it said 20%, but here it's 21.34. That's because depending on when you invest, there is small up and downs here. Now imagine in this, whenever the market falls, like how it has fallen now, you actually put your SIP. That small 1-2% that you were trying to over optimize in life, that can be optimized here instead of just randomly going last 3 years, Bandhan small cap, this last 5 years. Instead of doing that, every time the market falls, take a small bet and invest in the SIP in that fall time, right? Now, if you look at how much you would have invested over these years, last 10 years, you would have invested 13 lakhs. Your current value would be 46 lakhs, right? And obviously, we're not going to exit this. We will continue holding this for a longer time frame. Now, if you are a young person, then small cap and mid cap would be the way to go for the next 15-20 years. If you are not a young person, let's say you're in your 45s or 50s, then you would rather lean towards the Nifty 50 index funds, large cap funds, mid cap funds, not too much allocation in small cap funds. Now, coming to what I do, right? Because I'm still in that 32, 33, now I'll be 33 next week, but 33 bracket, okay? That means if I have to wait till 60, sadly, to enjoy, I have 27 years of compounding. So now let me just go into a calculator and show you how I would do things, right? So basically what I do is I do an SIP of 1 lakh every single month. Now this is not an automated SIP. I don't do it automatically on the 5th of every month. I do it only when the market falls right now. Okay. So when the market falls, I put an SIP into it. I'm ready with the capital. Now, obviously I have 1 lakh. Again, it is high for a lot of people. You can also put yours at 10,000, 20,000, 30,000. It's because I'm 33 now and I've been focusing on active income for 7 years. Hence, I can do 1 lakh SIP as of now. I still feel 1 lakh SIP is less, but as of now, it's okay. Now, coming to expected rate of return. Now, even though it showed me 21% or 20%, I am not going to take 20%. Because I also have to realize that last 5 years was in a massive bull run. So let me take a normalized rate that before the bull run, small caps used to give anywhere between 17 to 18%. So I will take 18%. Now, time period, I have 27 years of compounding. Again, after 27 years, I don't need to exit it, right? But I can continue doing an SWP or something like that. So now if I just do this math and I just stick to it, 1 lakh every month, 18%, assume I don't even do that step up, web up nonsense. Just 1 lakh. Okay, obviously I will increase it over time, but just 1 lakh for 27 years, my invested amount would be 3 crores. My estimated returns would be 59 crores, almost 62 crores at the age of 60. Now you might say, Shashank, 62 crores is generational wealth. It is amazing. It is not generational wealth. It is not amazing. It is good wealth because inflation bhi aata hai na isme. Inflation also comes at around 6%, 5% every year. So if I reduce the inflation rate here and make it 12, you will see that it is actually 21 crores of pure money. Aaj ke time pe 21 crores. As I said, it's not generational wealth, but it's good money, not an issue. So, but do I have any other option? No. Is this simple? Yes. Do I have to focus on last 3 years, last 5 years? Absolutely not. Just stick to a system, stick to a pattern and focus on being invested for 27 years and 100 problems will happen in the market, which is actually an opportunity for you. Whenever Nifty goes down like this, take your SIP and put it in the market. Right? This is when you actually compound your wealth really high. A lot of people, what you do when the market goes up, you start investing and that's where you do the contra type of investing style. This style, on top of this 18, you can get 20 to 21% if you just invest in the market lows like as it is right now. So again, I showed you, don't over optimize. Okay, 1 fund or 2 funds. Don't over optimize. Don't overthink. Every year, don't go to historical returns. Shashank, last 3 years, last 5 years, kya karu? I think this is best now. Be quiet. Just stay invested for 27 years. In fact, now you should be more worried that 27 years, the Konsa bank will continue the mutual fund properly. Right? I don't know about Bandhan Bank. Maybe, maybe not. I don't know about ITI. Maybe, maybe not. But at least now SBI will be there. HDFC might be there, Axis might be there, ICICI might be there. I'm okay with this. Itna hai basic, so I'm sorted. So that is how I would do this. So this is how I would choose it. Now, if I had to choose, Nippon India, HDFC, Axis are the three funds that are in that good top three range, right? Nippon obviously would be best, which is return adjusted to expense ratio. Then Axis, if you really want to just chill out and not have the AUM worry, HDFC would come in number 3. Okay, so these are the top 3. Now again, in the next video, I will also do a mid cap series like this, and then I will do flexi cap as well. So I hope you guys understood this. Again, guys, if you want to know more about investing in mutual funds and you want to understand more about that, you can definitely check out the Grow app where all these mutual funds are available, and you can go download the app and check all of this out as well. The information for downloading the app link is in the description below. Awesome, guys. I hope you guys enjoyed this video and liked this video. And if you did, click on that like button, because I come here and do a lot of work for you guys. Just one like button. Subscribe nahi hai to bhi chalega, no problem. And I will see you guys soon again. This is me, Shashank Udupa, signing off, guys. Take care. See you guys. Bye bye.